Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Gold has entered uncharted territory. The safe haven metal has soared more than 60% year to date, crossing $4,300 an ounce for the first time. That was earlier this week. Meanwhile, copper, often seen as a global economic bellwether, is grabbing investor attention amid US dollar concerns, rising policy, and M&A activity all over the place. So what might this all mean for investors navigating the global energy sector? And as AI transforms Canada's energy landscape, how is our next guest positioned across the natural resources discussion? Joining us here to dig into what is driving the move in global natural resources is portfolio manager Joe Overdevest. Well, welcome to you. Good to see you.
Thank you, Pamela.
And just for everyone joining us, this is with live audio, French audio interpretation. So do join us in either official language. So we mentioned gold there, certainly. I think we all know the story. Everyone's been watching this. It's just tripping over itself to get higher. Any reason to think that will slow down from your perspective?
I think right now when you have to step back is why is it up, and if we're going to figure out where it's going. I think the factors are in place are still there for it to keep going, but let's take a step back. Why? Well, first of all, sometimes gold moves because it's an alternative currency, because people are negative on, in particular, the US dollar or other currencies, or they're making a view that interest rates are about to fall, which would be negative real rates. And we see, or there's speculation, because gold generally is driven sometimes by speculation. So past times you'll see more of a US dollar trade or speculation. Gold and silver both go up. What's interesting about the last few years where gold's had a pretty big run, it's front page news recently, but it's actually been quietly doing well for a few years now.
Since the war.
Since the Ukraine war, yes. So Ukraine crisis happens, and that was a wake-up call for a lot of other central banks around the world and countries saying, maybe we need to own a little less of actually US dollar treasuries. And so on the margin started buying more gold. And so that's why you've seen gold move so well and actually silver do well, but not as well as the past, because this cycle is more driven from central bankers and less about actual speculation. But also I think what's more recently now in the headlines is debasement of currencies in general. People are worried politics these days, everybody seems to be spending higher and higher budgets. And it's very like whatever the people want, we're giving it to them. But deficits are growing across, especially the G7 countries. And there's a concern, and that's where you're seeing priced into potentially gold, is that at some point in time, that's really negative on currencies and a potentially debasement of them. And if you're going to get out of this debt situation, so gold is up on central bank buying and a lack of confidence in currencies, especially what we call currency debasement. Yeah. And until maybe the governments start, hunkering down and balancing budgets, or central bankers feel more comfortable with the US dollar treasury, you definitely have those pillars still there evident.
I mean, there's a lot of liquidity out there too. I mean, just to sort of mop up from the liquidity that's sloshing around out there, a lot of people will choose gold as well.
Yes, I think definitely in the market right now, you're seeing people enter, obviously, the equity market. Yeah. You're seeing people enter gold. I think in general, when we look back at other cycles, I wouldn't say it's extreme animal spirits, but there's definitely a positive tilt towards capital markets.
Yeah, it's fascinating. Let's go to sort of the Canadian economy itself. We've got some inflation numbers out this morning. Looks a little hotter, although it appears the central bank is on track to lower rates and continue either to hold or lower. What's the state of sort of the inflation story within Canada and our economy more generally?
Inflation has been coming down in Canada and the US. I think the bigger issue right now for central bankers here in Canada is more just a concern of the economy. And probably the bigger one they take when they take a step back is the uncertainty of the USMCA. And even
it's the trade story.
Exactly, because that will then set up what we do with the budget. That will set up is unemployment going to go higher. And even potentially a knock-on inflation, because you've also, if demand starts weakening, inflation will come off pretty quickly. Yeah. So I think they're less worried about the inflation story here and more looking at what's the uncertainty of the economy and the overhang of trade, which is very difficult for a central banker because there really isn't a lot of certainty out there. But that uncertainty, I would say, is an overhang and pulls back spending at the consumer level and the business level.
There is lots of discussion about what will or won't be in the Canadian budget this upcoming next month. A lot of it has to do with natural resources and the development of those natural resources that sort of has either stalled or has not been able to get through approvals and so on. Take us through what you, from your investment perspective, from looking at the natural resource landscape across this country, what would be a few nice to haves from an investment perspective for you in the budget?
Yeah, I think the budget too, almost back to what we said with the central bankers, they're waiting on as well. Even some indication where trade negotiations go. Sadly, is our American partners are not in a rush to actually maybe sign something massive because they're dealing with other things, in particular China. But the hope is something comes out in the meantime, especially with Section 232, that we get clarity. The reason why that's important is because
which is steel, aluminum,
and autos
and
in particular. Because if you don't get clarity there, it's tough to do a budget. Because all of a sudden, if they're really punitive or it gets worse, you might have to actually have a bigger deficit because social programs have to be helping these people out. So when we look back at the resources, what would be nice is gold and copper right now. There's a large amount of mines that are very profitable to bring on, and I think the biggest thing there was just be permits. Permits the last few years have been really difficult to bring on. So some of these mines can take 5 or 10 years, at least 5 years probably to actually bring on. Is the permitting process it can be a year or two. It'd be nice to at least shrink that. And when it comes to even our trade partners in the U.S., potentially as well, it actually may be a benefit to us to show we're bringing along projects early, especially on the copper side. Okay. And that actually may help us in the negotiations. Okay. I would say though, we also have to understand that not everything's the same. So right now, oil and gas, if I told you could have quicker permits, there's not a large amount of projects you could probably see going really quickly. The reason why, commodity's low, right? And that's why gold and copper, you could see it moving very fast if all of a sudden permitting happens.
Because the world has enough oil. I mean, there's a scarcity issue that's not really an issue these days with oil and gas.
Look, the capital markets are very, very efficient. And so just because something is able to actually bring on doesn't mean they'll do it. Right now, when you see oil, it's definitely different in copper right now. The tighter commodities are probably, definitely on the copper side. Further down is oil, and probably further down is natural gas. And the reason oil is different is that, supply is actually being increased by OPEC. And they're increasing this year. They're looking to potentially increase next year, which is probably more aggressive than they've normally been, where you consider where oil prices are under 60 and they're still releasing barrels. Whereas copper, you don't have no kind of cartel releasing barrels. So demand is similar, but the supply picture is drastically different in oil versus copper. And lastly, what would be nice in the budget is I think terms or incentives of some kind. Obviously,
like how to structure a deal to get something done, who the investors could be if such there would be a tick list.
Yeah. So again, it all depends what the government would like to see move forward. Maybe it's copper projects. Some of these copper projects just need permitting and they'll move forward on their own. Right. Some of these like rare earths, which are in the headlines a lot, they probably need incentives in some cases because depending where they are or what kind of mine, the reason they weren't brought on in the past is they're higher cost, right? So now if you also incentivize it because your U.S. trade partner would like that, and it will help you somewhere else, maybe with auto negotiations, you might do that. And so I think is that the terms of, is it tax incentives? Is it giving money directly, actually funding it with very cheap cost of debt? All these are things that a government can do. And the U.S. in particular, you're seeing that they're doing it as well right now with their mining companies and directly investing with them. So
is that the fastest way to do it? I mean, I'm not saying there's a whole moral discussion in there that we won't get into, but it's it's a direct bloodline to getting it into the mine itself.
Look, money talks. If you write a check and you say it can go on, the mine can go on really, really quickly, it's tough not to say that isn't going to be a huge benefit kind of thing, right? Okay. So I think that's where I think it'll be interesting, where the capital markets and potentially the government come out together and go, how can we win and provide for a better Canada going forward?
So there is much discussion about the Canadian, the Maple 8, the pension funds across Canada that fund lots of amazing airports and new infrastructure projects in every country except for Canada. And that's just the way they've worked, and they've made great returns, generally speaking, for pension holders. The discussion is whether they come and do some of that investing here. Again, I guess what would they need? Slightly different investor.
Yeah, I think with the pensions funds, big or small, just capital allocators in general here in Canada, I think a lot of people who are pensioners are probably going there with maybe some social kind of pressure saying, it's nice that you invest, in different places around the world, but maybe there's on the margin we should look within. Whereas in the past few years, probably our major pensions have moved probably slowly away from Canada the last kind of few decades. Number two, though, there is a fiduciary duty where you can't overcome what your returns hurdles are supposed to be, but
the company has to perform whatever it is you're investing in.
But to your point where we were originally discussing too about the government maybe coming in is, these are huge pools of capital. If the government comes in and goes, we will partner with our pension funds, give attractive returns that will benefit our Canadian pensioners as well as help our Canadian economy, that could be a win-win. And that, I think, if it was, again, attractive returns, I can't see how any capital allocator, especially a pensioner, pension company, would actually sign on for that. Yes.
It's really interesting. So the terms that they would need would be permitting, would be a big piece to get that.
One, yes.
That would be the first one.
Yeah. Number two would be actually like, do we have attractive financing? Do we have tax benefits? Is there major grants?
Just back to the critical minerals, because it also gets in the headlines an awful lot. China has a lot of them, and they use it for all kinds of different things that they're developing, defense and EVs and so on. Do we have a ton of them here? We just can't get to them? And could we get to them? Do we need a ton of them? What's sort of the amount that we're talking?
Great question. Critical minerals, the biggest areas are actually still China and places like Brazil and other countries. Canada, we have some, not a lot, but we have some. So in these days, critical minerals anywhere in the world are a strategic view when you're negotiating with the U.S. So you can tell it's a very big sensitive issue with China and the U.S. So you obviously saw this morning, Australia and U.S. have done a deal to bring on the critical minerals quicker. Just like you said, they're injecting money into the system, Australia is, and the U.S. is.
There's a defense deal announcement, so 24 hours ago, and then this one.
Yes, that is politics. Yes, there's always a negotiation. And so, again, maybe if we can provide something on the critical mineral side in terms of mining it or processing it, maybe that helps us with some negotiations somewhere else with aluminum, steel, or autos.
I see.
But I think it's really important for the audience because some of these people say, this critical mineral, why is it such a big deal? Ironically, it's copper's 30 times bigger than the market. So the critical minerals...
Oh, really? So it's quite small.
It's very, very, very small. But what happens is the reason they use the word essentially critical minerals, all these different minerals that they include, is in many cases, like you said, EVs, iPhones, certain things for the defense sector are critical to have these minerals and part of the process of manufacturing. And if you don't, you actually just can't produce the product.
Even if it's a small amount going into them, you still need it in order to actually make...
Yeah. And what's interesting about with China strategically over the last few years has probably the biggest in terms of mining most of these minerals, and number two, refining them. And they actually strategically have, made sure they invest in the refining side of things. So many of the critical minerals around the world actually get sent to China to actually get refined.
Right.
And so that's where you can solve it two ways. If you don't have the mining, maybe you provide the actual refinement of it as well. So we'll see where the Canadian government or other governments come on top of this.
I mean, Canada's not really known to refine anything.
Well,
right? I mean, maybe we should.
I think this is where it'd be interesting is that if you go back decades, I would put refining, smelters, oil and gas refineries. Not many have been built, essentially, unofficially almost zero the last few decades. And this is where it'd be almost what you were saying originally. Maybe a look word within is where's our infrastructure here been in Canada? And maybe we can also help ourselves and help with the trade negotiation in some of these investments.
That's fascinating. So if we go further afield to things like nuclear, which has been discussed for a long time, and of course the stock prices of on the uranium side have been, they've been a story that I wonder if it's almost over for a little while because it's been such a run up for the last couple of years. Mm-hmm. But broadening out to other types of energy, what else is interesting to you as an investor?
What I think uranium is still interesting is that you have to watch how the U.S. government looks at this. And so the U.S. government right now is driving a big part of what's going on in commodities because they're writing checks, number one, and number two, they're using these commodities in negotiations. And so you're seeing that with Australia, potentially here in Canada. And the uranium one is that, that chapter may still be written, is that it'll be interesting if the U.S. government looks at how much uranium is done through Russia and goes, you know what, we need to make sure this is maybe less reliant on Russia going forward. Canada would be an obvious one to look towards kind of thing, right, as a benefit to us. And again, maybe it's saying we're going to maybe guarantee a certain price, but we want direct ownership of all your supply or a major part of your supply, and we don't want it going to other parts of the world, potentially.
Right.
When it looks at other parts of the value chain in terms of energy, obviously oil right now has an overhang with OPEC. I think with natural gas, people get excited because there's a lot of energy needed for these utilities. So you take a step back even further, these AI data centers, every time we talk, the numbers keep getting bigger. Of course, the numbers can change, but the numbers are quite big, right? And that grid, especially in North America, has been really no major demand on it for almost 2 decades, is now seeing major demand with data centers. So we're going to need wind, we're going to need solar, we're going to need nuclear, we're going to need gas. And
anything you can throw at it
everything.
At the moment.
The one thing I would just say, though, is that there's a large amount of gas in the North American market. So it may be more of a volume story than a price story. So what it means by that is that we'll use a lot of gas, but don't just expect the gas price to go skyrocketing up like you normally would just because there's a large amount of supply. If it will help the volume story, that's actually your utilities in Canada and the US. Right. So for a long time, they would grow like 3, 4, maybe 5%. Some are now creeping up 5, 6, 7, 8% growth. Well, for a utility company, that's a pretty big deal with massive, a 5% dividend yield. Yes.
Right. Because they were bond proxies, essentially.
Exactly, right.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
It's really interesting in terms of kind of coming back to the budget or how Canada needs to pivot or we think will pivot. The passage of the One Big Beautiful Bill in the United States had lots of things in it, but the tax cuts and the deregulation element is very attractive to companies and leadership of companies. And we have seen Canadian companies going to invest in the US for lots of these reasons.
Yes.
And the sort of stick side of the tariff negotiations as well. Again, do we not have to cut taxes in Canada to compete on some level? Like, it's always sort of been a discussion, but is it now a bit of a priority, would you say?
Look, I think as a politician, they always have tough jobs to balance, and I'm not in that seat, but I would say when we talk to our major companies, we had a very busy September with financials, banks, consumer, industrial, obviously materials, conferences. So we met a vast array of companies, and feedback on this in particular was, it's really difficult right now if you're a major company and you're global, and many of our Canadian companies are, is they go, okay, I can invest in Canada or invest in the US, and the US have 100% bonus depreciation. Right? So it's 100% write-off year one, and Canada, I don't have that. Just that alone, it changes your economics, right? So I would say, and I think that's what we've been hearing from the executives, is that their feedback to our Canadian government is just understand that capital moves back and forth. And in time, when you've actually looked at Canada and US and we've done well, our tax rates are generally similar, especially on the business side of things, because business money moves pretty quickly. A plant can be put on one side of the border or not. And so I think you're going to have at least a discussion that, like, do we have to match that? Do we have to come close? Like, what incentives do we have to do? Because otherwise, on the margin, the next plant will be moved to the other side of the border. And so it is difficult.
It is difficult. There's a couple of questions coming in. This one is the amount of energy that will be required to power AI generation, how this might affect energy prices. I think you've sort of gone, particularly for consumers, I think you've sort of answered part of that. But the question is, paying whatever bills we're paying that have to do with grid and all kinds of energy in our own homes, lives, and so on, is that going to be a crunch because of AI generation, power for it?
I would say if it is, politicians will
have
be kicked
another
out.
problem.
Yeah, politicians will be kicked out of their position pretty quickly. I think we've seen this more in the U.S. because it's moving a little faster in the U.S. than it is in Canada with these data centers being actually named and starting construction. Is that it is a no-go that you are going to say, we're allowing a big hyperscaler to build a data center and my utility bill is going up.
Yeah, we're going to drain that from the local community.
Yeah, that is no-go. That like the local community will be in uprising and either kick out the government or do something. So I think what you're seeing is more deals that you hear these terms like behind the grid or different things. Is that you're going to essentially have is that we want energy. We need the transmission. We need the actual infrastructure that the grid already has. We'd like to tap in. But they're going to have to negotiate a deal where it's like, we pay a higher rate. Right. You almost have to guarantee that the local user does not pay a higher rate. Because
Everything
Otherwise,
will have to be built on top of the rates that
Exactly.
are currently the status quo.
But I would say you potentially have that opportunity because right now the actual cost of energy in an AI data center is high, but like if they pay a higher rate, it's not meaningful for them right now in terms of their economics. For the actual individual, it is meaningful for their daily lives. So I think you can see a bridge there where both could be happy.
The discussion of, you just mentioned some of the conference that you went to and really busy in the fall. Let's go to the financials. At one point, a couple of years ago, all we were talking about was the mortgage cliff, essentially, and what was it. We're in it now.
Yeah.
And the banks are not creating as many provisions for credit losses as they have been. Tell us the state of the financials from your perspective, again, as an investment.
Yeah. As an investment, the banks right now probably have front-loaded a lot of what they call PCLs or the credit. And right now what you're seeing is, economy, like I said before, it's doing okay, not amazing. The U.S. economy is doing better. So for credit losses, they shouldn't massively move up unless you have job losses. And so really that USMCA deal or the overhang of trade is probably going to be the biggest driver of that going forward. If it's subdued or similar to what we have now, you probably have similar views that, probably credit is where it is now is fair, right? At least from the bank's feedback, whenever they talk on public calls, they're like, the trade is our biggest overhang. Right now, if everything is fine, then we're probably okay with our credit losses. When it looks at the insurance side of things, property and casualty has done very well the last few years here. Again, your auto insurance, your home insurance, that pricing is now starting to come off. Maybe it's still going to be positive, but it's less positive than it was before just because you had so much inflation. And we had, especially in property and casualty insurance, I'm sure the viewers noticed this with their home insurance.
I was going to say, phew, it's coming off now.
It kept going up and up and up. And just like anything in the capital markets, new supply has come in, new competitors have come in and said, we'll write policies at a lower rate. It's bringing rates down a little bit more. On the asset management side, still that you see alternatives are still in demand in terms of like infrastructure spending, renewables, and now even data centers, even the pension funds or even the alternative providers of capital are all saying we're actually, have dedicated funds just for data centers and to provide the real estate, to provide the actual building, to provide maybe some deal with the local utility company. So that is still probably a growth area right now for the asset management side.
Do you find these markets like intellectually just pretty fascinating? It does feel like we're on the cusp of revolutions within the marketplace and industrial revolution.
I think one of the reasons I and many of the people that work here, we love Fidelity. One of the things about Fidelity in the markets, it's very intellectually stimulating. Yeah, and for some people, it can be intellectually overwhelming or it can be stressful. But I think we don't get stressed is that we think of it as an opportunity. And we look at, we have the resources, we have the investment team of 400 investment professionals in the world. Take these opportunities to say, whenever there's change, there's opportunity, right? And I think when you're in these situations and it can be very volatile, that's why you're not stressed. That's why you're not like, aggravated. You're just actually excited to what could potentially turn over. Because as you said, things are changing. And, the view on copper or uranium could change with a tweet. All of a sudden, someone goes, this is a strategic thing that we need to do. It could drastically benefit us. We have to be ready. Right. Mm-hmm. And then on the flip side as well.
It could go the other way.
Yeah, exactly. So, but you're right. Commodities are changing. Currencies are changing. The world is changing. But just like anything, that's the world we live in. And sometimes are a little less volatile and sometimes are more exciting. And this is definitely more of an exciting time, yes.
I mean, is it as it's a different buyer? The commodity super cycle was because China was buying, and that was their build out. It's a different sense right now. But is the U.S. able to create a commodity super cycle globally? But for Canada,
I think the U.S., if they want to buy certain commodities, can make it go up a pretty significant degree. But I think for them, it's probably more strategic. So uranium, you have to watch because there's right now they're not doing anything, but that could be a focus. Yeah. And that's not a big market. Number two is that probably copper, and number three is rare earths. Those are probably the key. Find the strategic ones the U.S. is looking at. Oil, you'll probably ask me about. Yeah. Oil as well is strategic to them, but they have a large amount. And so I think they're not. I don't see them tariffing us or taxing our U.S. oil because they don't want to play more at the pump. But I don't think they're going out of their way as well to make sure that's a strategic asset just because they've done a great job growing their own base.
I mean, some would argue that their own base has changed so many things, the geopolitical map of whether they've needed to import oil or not into the U.S. So why does Canadian oil sell so well to the U.S.? I'm just curious, because they do have their own.
Oh, yes. I think for us, it's actually more of a legacy.
Okay.
Is that many of the refineries there that make, of course, gasoline or diesel
that refine our oil.
Yeah, exactly. Are set up in particular for heavy oil. We've done traditionally for many years sent heavy oil there, and we do a great job at it. And it's the right grade. So when you do a refinery, it's very sensitive of what actually goes in to actually what goes out. You can't just say, oh, we'll just take light oil from the Permian.
Right.
It just doesn't work that way. The mechanics of it aren't like that. So they love our heavy oil. They have the pipelines, the infrastructure, everything set up. So it's very efficient for them, and it's very low cost actually in terms of transportation.
Okay, pipelines. You said the magic word. Is that I mean, out of the budget for investors, some sort of announcement on pipelines? Actually, there have been a lot of discussions and sort of mini announcements, but like actual pipelines would be a big one, right?
Yeah, so pipelines could be two things. It could be obviously an LNG pipeline. It could be oil pipeline. From the capital markets perspective, I would say the capital markets aren't like, oh, we need something right now. In history, you've seen sometimes where we've been short, especially oil pipelines, and so your oil trades at a massive discount. That's not where we are right now.
Okay.
So what would be interesting is that actually it goes back to the bigger view. What does Canada want? If Canada wants a lot more oil and resources to be built and to be brought on production, you're going to need more pipelines. But right now, we're still almost in the steady state of we're hearing a lot from the Canadian government. The last few years, they definitely have not allowed or encouraged oil investment. It was not a top priority, so no one's really growing oil production. Hence, you don't need pipelines, right? I would say, though, we've been doing this enough, you and I, on this stage, is that pipelines cross provinces, and there's a lot of sensitivities. And this is where I think the U.S. government sometimes just goes over the top and goes, it's happening, this infrastructure is happening, and they overrule the local states. Here, and it is what it is Canada. We're probably a little more respectful of individual needs of the provinces. So just saying that at a federal level we want pipelines is a little more complicated.
Right, yeah. It's a little more complicated. But still, it's sort of a big discussion about what is needed. What would you say this time is like for investors? What sort of investing moment is it? You hear a lot about diversification, a lot about opportunity. How would you kind of sum up this moment for investors?
I think there's lots of opportunity. I think, again, you can look at it and go, there's change in AI, in technology. It could be a new platform for technology in general. You look in the resources, there's obviously concern about currency and debasement. So you see gold moving, copper, your weakness of supply. And quietly, the Canadian market is outperforming the S&P 500.
It's incredible.
Exactly. It's as good Canadians, we're very humble about it, very quiet about it. But we're doing okay. And
you don't want to interrupt.
Yeah, exactly. So we'll just stay really humble and quiet as Canadians. Look, I think we're really excited, and we're talking to our companies. We have a number of conferences lined up, and we're just trying to look for great ideas. And the market usually offers it the more you look and turn over rocks. That's
brilliant. You often will bring to us a couple of books you're reading or things that you're doing to stay current that you share with us. Is there anything you're either listening to or watching that we should know about? Maybe we should check out.
There's a few, but I'll give two highlights. One would be the NVIDIA way. And so it's the book, essentially, where did NVIDIA come from and how did it get here? So I met Jensen. He's an amazing CEO and obviously founder. But the book, even for me, enlightened just how intense he was and how smart he was strategically building that company over the time. And you could see where they are now strategically also from international perspective, where chips are actually very strategic. And you can see where they kind of almost are now in the view of major politicians of do I have chip access or not?
Right.
Number two is a book I've suggested here on the show is The Psychology of Money. Mm-hmm. The author recently came out with a new book. It's just come out.
So what's his name?
Morgan Housel.
Okay.
And The Psychology of Money, he's actually on Capital Allocators this week, and it's a podcast. So if even you don't want to touch the book yet or you just want to test them out, it's a good way for this audience. You have a book idea, and now you have a podcast idea.
Okay. Oh, excellent. Okay, well, we will check those out. Joe Overdevest, great to see you. Thank you so much for sharing your time here today.
Thank you, Pamela.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.